Tell me, which asset class offers no guarantees and no fixed rate of return? But once invested, there is no limit. You can either gain 100% in a year or lose your entire principal. Well, I'm talking about equities. But while this sounds risky, in this video I'll tell you why it is still worth it, and despite all the risks, there are still not one, not two, but 5 reasons why you can consider investing in equities. But before we get into the details, like and share this video, and don't forget to subscribe to the Moneycontrol YouTube channel. Now coming to the main point, why should one invest in equities? Now equities help beat inflation. When prices rise, companies generate higher revenue and profits, and when companies increase their revenue and profit, their stock value grows in tandem. So part of the rise in equity markets around the world is simply inflationary growth. Therefore, inflation is one of the reasons why it's better to be an investor than a saver. If you really think about it, it's quite simple. As an investor, your asset prices go up with inflation. But as a saver, the value of your money only diminishes over time. Markets bounce back after a downturn. Sell-offs, downturns, crashes. They happen all the time, but don't tend to last forever. Why? That's because governments and central banks take action. Throughout history and world over, when markets have been in serious trouble, central banks and governments have taken extraordinary measures to restore them. Secondly, markets are viewed as the future barometer of an economy, and if the future of the economy remains forever gloomy, companies or industries will be forced to shut down. But it doesn't really work this way, because it's a cycle, and cycles always turn. Better returns on investment. One of the most significant advantages of equity is that you can get better returns on your investments compared to gold, real estate, and fixed deposits. Long-term returns from equities can range anywhere between 14 to 16%, whereas returns from FDs will at best be in single digits in percentage terms. Meanwhile, gold, which is often looked at as a safe investment bet, is often volatile and affected by a slew of factors like inflation, GDP, and the likes. Even the rate of return from real estate, both commercial and residential properties, averages much less vis-a-vis equities. Now, thus, equities have a considerable edge over other avenues in terms of returns. Number 4 is liquidity. Unlike other investments, equities do not have a lock-in period, so you can sell your shares and liquidate your investments whenever the need arises. And number 5 is tax benefits. Another major benefit with regard to equity investment is the option to set off capital gains. When you sell your shares to another shareholder for a higher price, the profit you earn on the resultant transaction is what is called capital gains. Now, if you buy shares and dispose them after 1 year, it will be counted as long-term capital gains. But if you fall in this bracket, you will be exempt from paying tax on equities up to 1 lakh rupees. But if you decide to sell within a period of 6 months, you will be levied taxes in the form of short-term capital gain taxes. Well, the good part is the short-term capital gains can be offset against short-term capital loss of another investment. Suppose you bought a house and sold it within 2 years. There's been a downturn in the realty market and you ended up incurring a loss. Now, this will qualify as a short-term capital loss. Now, suppose you purchased some shares and sold it within 6 months and made a profit. Now, this will qualify as a short-term capital gain. So you can offset your losses from your realty investment against the gains from your equity investments. Now, you may have a clear answer as to why you should invest in equity shares. But before you go all in, keep these pointers in mind. Factor in share market volatility. Pick stocks after researching and analyzing them thoroughly. Be patient and don't always follow the herd market. Monitor your portfolio regularly to make sure that your investments are getting returns. Lastly, how much money should you invest in equities? Well, the answer is ideally one should invest that much money in equity which is not needed for at least 3 to 5 years. Further equity allocation largely depends on your risk appetite and age. Well, hope this video helps you kickstart your investment journey. For more such videos, keep watching Moneycontrol.